Hey guys, as a dividend growth investor, you know what kind of artwork I really like? It's masterpieces like this one. Don't you just love the long, gradual, gorgeous staircase pattern? Talk about a stairway to heaven. That lovely piece of art is the dividend chart of my latest choice for the income builder portfolio. It's a dividend aristocrat that dominates its industry. It's crushed the overall market 5-1 so far this century, and it's been growing earnings, revenues, and dividends for years and years. Hi everybody, I'm Mike Nadell, here for the Dividends and Income channel. Before I talk about this great business we just bought, do me a favor to help us grow our channel, will ya? Pop the thumbs up at the bottom of the video, subscribe to our channel, and ring that notification bell so you get notifications of new videos as we publish them. Okay, let's get right to it. The stock I'm talking about today is McCormick & Company, symbol MKC. It's the world's leading maker, marketer, and distributor of spices and flavorings. And on January 26th, I added about $1,000 worth of it to the IBP on behalf of this channel's co-founder, Greg Patrick. Greg allocates about $2,000 a month for me to make two buys for the portfolio. And this was the second time we bought shares of McCormick. But it's the first time since all the way back on May 29th, 2018, only a few months after we launched the IBP. So why did I wait more than 3 years before picking McCormick again? Largely because it's one of those stocks that's almost always overvalued, something I'll be discussing in a little bit. First, let's talk for a minute about McCormick's dividend. The folks at McCormick have grown that bad boy for 34 straight years, and the average annual growth has been 10% over the last 20 years. Although some dividend growth investors might prefer stocks with higher yields than McCormick's 1.6%, you gotta love that kind of consistency, and you gotta love the company's commitment to dividend growth. And with McCormick's leaders keeping close tabs on the company's payout ratios, there's every reason to believe that many more years of dividend hikes are in the offing. After the July 26th buy, the IBP now has approximately 33 shares of McCormick. In October, that'll produce $11.22 in dividends. And if history is any guide, McCormick will announce its 35th annual dividend raise right around Thanksgiving time. Oh, and here's something pretty exciting. This latest buy of McCormick has pushed the portfolio's annual income stream past the $3,000 level. I love milestones, and that's a pretty big one for the IBP. At $3,010, we're now more than 60% of the way to our income target, which is $5,000 within 7 years of the portfolio's inception. What's cool about that is we're only about halfway through the 7 years, so we're way ahead of schedule. DGI actually is a long-term strategy that truly bears fruit after years or even decades of compounding. But I know this project might not last multiple decades, and I needed something to shoot for. So I went with nice round numbers, $5,000 in 7 years. I felt that was ambitious for sure, but it's also realistic. I'm always updating the Income Builder Portfolio's homepage on our website. So if you'd like to learn even more, make sure you check out the IBP link in the description. Please remember, I'm not suggesting that anybody replicate the IBP. No, I do this to get folks talking about portfolio building concepts and also to present interesting investing candidates for you to research thoroughly. Candidates like McCormick, which has been a market-crushing investment for years and years. McCormick is a well-run company whose balance sheet is always appealing. Lately, earnings growth has slowed just a little bit, but the company's still raking in profits, and sales have been outstanding. Debt had climbed after the expensive 2017 acquisitions of Frank's Red Hot Sauce and French's Mustard, but the company's working hard at paying down that debt load. Even as it pays down debt, McCormick still isn't sitting still. Last November, the company completed its acquisition of Cholula Hot Sauce. A month later, the company finalized its deal for flavorings business, Fona International. Management says both recent acquisitions are already making material contributions to McCormick's bottom line. McCormick was a big winner during the teeth of the pandemic, as people stayed home to cook. In its most recent earnings report, July 1st, the company said consumer demand was down a little as more people ventured out to eat, but sales to restaurants picked up as more folks went out to eat. So all in all, it was another impressive quarter for the Spice King. Alright, now let's talk about the performance of McCormick's stock. When I did my year 3 total return review of the Income Builder portfolio back in January, I was a little surprised to see a boring spice maker in the number 2 spot. That's right, McCormick performed even better than tech stalwarts like Microsoft and Broadcom. From the May 2018 day we bought McCormick through September 2nd, 2020, McCormick's total return was almost triple that of the overall market. It was trading at 35 times projected 2020 earnings. Outlandish for a consumer staples company that's steady but hardly hyper-growing. McSpicy had become too pricey, and something had to give. Well, something turned out to be the price of McCormick's stock, which has fallen about 20% from its all-time high. This can be one of the problems with momentum investing. One of the problems was saying, valuation doesn't matter. This rocket's going to another galaxy. Buy, buy, buy. McCormick wasn't just a little pricey, it had become extremely overvalued. Its growth has been fine, but it's nowhere near robust enough to justify a 35 PE ratio. That doesn't mean McCormick became a bad company. It's still the world's leader in its industry, and it's still growing earnings, revenue, and dividends. But to coin a term, its stock price just got ahead of itself a little bit, which brings us to here and now. Morningstar's analysts love McCormick's wide moat business, but they say the stock is still extremely overvalued at about 28 times this year's projected earnings. No way, says Credit Suisse. Their analysts are bullish on McCormick, and they're forecasting 20% price appreciation over the next 12 months. Value Line also is high on McCormick's prospects. Their 18-month and 3 to 5 year target prices are projecting gains of about 35%. Simply Safe Dividends, meanwhile, is right down the middle. They say McCormick's yield and forward PE ratio are right in line with the company's 5-year averages, suggesting the stock is fairly valued. Finally, let's take a look at what a couple of fast graphs illustrations suggest. If you use McCormick's 2-decade history, the stock definitely looks overvalued today. Its blended PE ratio is significantly higher than its norm, and the end of the black price line sits much higher than the blue line that represents the average valuation over the period. But if we look at the most recent 5 years, we see that the price and normal valuation lines are almost touching, and that's because the current PE ratio and 5-year norm are almost identical. That suggests McCormick is fairly valued. When I look at all that valuation information, I can't sit here and claim that McCormick is some kind of great buy, but I don't think it's crazy expensive either, and I know it's a great company. So yes, I feel pretty good about increasing the size of the Income Builder portfolio's position in the world's Spice King. And I look forward to watching McCormick keep painting its dividend masterpiece, its Stairway to Heaven. Okay, everybody, that wraps things up for today. I'll be back in a week or two with another video. Again, please give us a thumbs up, subscribe, ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.